In the second quarter of 2026, global smartphone shipments dropped by 11%, hitting a devastating 13-year low. The damage is heavily concentrated at the lower end of the market. Budget and mid-range phone manufacturers are seeing their manufacturing costs rise significantly, which is severely squeezing their already thin margins and forcing them to pass those price hikes directly on to everyday buyers. This chart shows core inflation rates across Southeast Asia. If you look at the data lines near the end of 2025, you'll see a sudden upward hook for Vietnam, Singapore, and Indonesia. On the surface, a budget smartphone slump and rising ASEAN prices look like completely separate issues. In reality, they are symptoms of the exact same shift in the global economy. It all comes down to a multi-trillion-dollar race to build artificial intelligence, and how that digital boom is physically driving up the cost of daily life. To make AI work, companies are building an entirely new generation of massive data centers to process vast amounts of information. Building this infrastructure requires immense volumes of physical hardware, specifically high-bandwidth memory components like DRAM and NAND chips. Because AI is highly lucrative, global chip suppliers have violently pivoted their production lines. They are prioritizing memory components for data centers and routing supply away from standard consumer electronics. When that memory supply gets diverted, it creates a severe shortage for phone manufacturers. Suddenly, the physical cost to build a standard smartphone skyrockets. This silicon shock translates a software boom into a physical hardware scarcity, which immediately forces price hikes onto the everyday consumer. But hardware is only part of the story. For years, China has dealt with its own sluggish domestic demand by flooding neighboring markets with incredibly cheap manufactured goods. By pushing these low-cost items abroad, China exported deflation, which kept global consumer prices low and masked other economic pressures building beneath the surface. That dynamic shifted heading into 2026. Beijing has started cracking down on involution, their term for cutthroat excess supply, by cutting export tax rebates and stabilizing the yuan. This dual chart displays China's consumer and producer price indexes, showing when price weakness bottomed out. Starting in July 2025, there is a distinct recovery. Both lines are on an upward trajectory, meaning Chinese exports are officially getting more expensive. The period of dirt-cheap Chinese imports buffering the rest of the world from inflation is over, leaving neighboring economies exposed to the full force of rising costs. At the same time, domestic demand in Southeast Asia is surging. Post-pandemic GDP growth in nations like Vietnam and Singapore is accelerating rapidly. Economists measure this using a metric called an output gap. When an economy's actual growth exceeds its safe potential capacity, it enters a positive output gap, meaning the economy is running hotter than its infrastructure can comfortably handle. This chart tracks output gaps across ASEAN nations. Singapore and Vietnam are running with the largest gaps, indicating high risk for price pressures. See their lines rising sharply above the zero axis here, contrasting with Thailand and Indonesia remaining below zero. Fast-growing economies are demanding more resources at the exact moment that the AI boom and shifting trade policies are making those very resources more expensive. This inflation wildcard forces a split reaction from central banks. Those overseeing hot economies have to aggressively tighten their monetary policy to fight off imported inflation. Institutions like the Monetary Authority of Singapore may have to steepen their exchange rate slope, adjusting policy to protect their local currency from the pressure. Meanwhile, central banks in countries with economic slack are moving in the opposite direction, likely cutting rates to stimulate their weaker domestic demand. Trillion-dollar AI investments physically compete for the silicon in our pockets, alter global trade routes, and ultimately dictate the future cost of living.